Hello, my name is Guy. I am the author of the book Business Valuation, and I'm going to tell you something how you have to make a financial analysis and to make a valuation of a company. To make the valuation of a company, you have actually, it's very important, two possibilities to make the calculation. We call it equity valuation models and we call it entity valuation models. And as you can see here, ECF stands for equity cash flow. This is the cash flow we are going to calculate. That is in fact the cash flow that belongs straight for the shareholders. KE means cost of equity, and I will explain you everything how you have to calculate all this. Another one you see here is free cash flow, which is not the same as equity cash flow. I will explain you what it is, but this free cash flow is nothing more than the cash flow which is there for everybody who put money into the company, that are the shareholders and the interest-bearing debt holders in medium-sized companies, normally banks. So we're going to calculate two kinds of cash flows, the equity cash flow and the free cash flow. This is cash flows, but if you have a cash flow of 1 million euros and you have invested 1 million euros to realize this 1 million euros cash flow, and you have another company that realized 1 million euros, the same amount of euros in cash flow, but invested 10 million euros to realize this 1 million cash flow, then you all now the value of these two companies will be different. But if you're using these formulas, they will be the same. So that's the reason why you cannot just make a discounted cash flow model, that's how you call it, but that you also have to work with economic profit. And the fifth method is the adjusted present value, which is going to help us to make the right combination between equity and interest-bearing debt holders. As you see, an equity value is in fact the value for the shareholders, and an entity value is in fact the value of the total invested capital of the company. So to get or to go from the entity value to the equity value, you will always deduct the interest-bearing debts. Important is that we will always work with a managerial balance sheet when we make a valuation, and a managerial balance sheet means that we are going to put the working capital requirement as one block on this balance sheet. You will find that back in session 2. Thank you.